Hello, I'm Dave Allison, President and CEO of Allison Wealth Management, and I wanted to shoot this video because we've had some major retirement and tax legislation that was passed today by Congress. Both the House and the Senate have signed this bill, and it's over to the president to sign. So I would imagine that within the next day or so, it will be law. Probably by the time you're watching this video, it will be law. And so the bill is the Secure Act 2.0. And the Secure Act 2.0 is actually an overlay to a bill that was signed back in 2019. It stands for the Setting Every Community Up for Retirement Act. And in 2019, we saw Secure Act 1.0 passed. Now, Secure Act 1.0 was an absolute game changer for the retirement planning business and for all of you that are accumulating money in pre-tax retirement accounts like 401ks and IRAs. Because Secure Act 1.0 eliminated one major provision which allowed the individual who inherits a retirement account to basically stretch out the distributions, meaning that if I inherited a retirement account, let's say from a parent of mine, then essentially I can take a small distribution each and every year over my life expectancy. By stretching out the distribution, it also stretches out the tax that's due because I'm not taking out a big lump sum that's taxable in one given year. I'm taking out a little bit of money. It's like a slow trickle out of the faucet versus a fire hose. It's going to create a lot less taxes. Now, what Secure Act 1.0 did is Congress came in and said, hey, we need some of this money now. We can't allow people to slowly drain these inherited retirement accounts. We're going to mandate that they drain them within a 10-year period. It compressed the time frame to take money out of these accounts, which also basically accelerated the tax liability that a beneficiary would owe on these retirement accounts. And so it made strategies like Roth conversions much more attractive. It made the utilization of life insurance for inheritance planning much more attractive. It changed the way we utilize trust, like living revocable trust or irrevocable trust for estate planning purposes. Secure Act 1.0 also extended the age that we have to take required distributions out of these retirement accounts from age 70 and a half to age 72. And so again, a required distribution is when the government mandates or forces that you start taking a certain percentage out of your retirement account each and every year. Well, Secure Act 2.0 didn't have any massive individually changing reforms in the bill like Secure Act 1.0 did, where it eliminated or killed the stretch IRA provision, but it had a number of small things that I think add up to a lot of good stuff in totality. The first one is required minimum distributions. So if you have yet to turn age 72 this year, then your RMD age is not going to be 72 anymore. It's actually going to be age 73. So that's one more year you can continue to defer money in those retirement accounts before you're forced to take out a percentage of it. If you're really close to age 72 or 73, it might give you a little extra time to do strategic Roth conversions for another year before your RMD turns on. Now, if you're younger, your RMD age is going to continue to ratchet up. So the goal is by the year 2033, the RMD age will be 75. Again, you need to think about this if you're doing multi-generational planning with your own assets, because if you continue to defer in tax-deferred retirement accounts like IRAs or 401ks, let's say to age 75, that might be a bigger balance left in those accounts when you pass away, which could push your beneficiaries into a really high tax environment. And so again, these are all the things that we need to think about when we add Secure Act 1.0 with Secure Act 2.0 and how these things fit into your plan. The next thing that I'm a big fan of is they reduced the penalty for missing an RMD. The penalty for missing one of your RMDs was 50%. It was one of the most extreme penalties in the entire tax code. So for example, if you had a $40,000 required minimum distribution and you accidentally missed it, then you were going to have a $20,000 tax penalty on top of the $40,000 of taxable required distributions. Well, Congress has decided to cut that number in half. It's now going to be 25%. And if you fix the missed required distribution in a timely manner, they're going to be nice enough to drop that penalty down to 10% for us. So don't miss those RMDs. One of my favorite provisions of this new law, Roth 401k matching. So again, if you're still contributing to a retirement account and you want to juice up that tax-free money that you have, traditionally, if we put money into our 401k, it could go either into a Roth 401k or a pre-tax 401k. But when our company puts matching money in, maybe they match 3 or 4 or 5 or 6% of whatever we put in, that match always had to go in the pre-tax account. Well, now you're going to be able to elect for that matching money to go into the Roth account to continue to build up tax-free money. So again, if you think that there's going to be higher taxes in the future, you want to try to get as much of that money in the Roth account as you can. Because again, that money is going to grow tax deferred and come out tax free when you think tax rates might be higher in the future. The next one here is a qualified longevity annuity contract. This is for somebody who's retired that wants to take a chunk of their retirement account and basically segment it out into a longevity annuity. A longevity annuity is where you defer the money in that piece of the segment until you attain a certain age. Most of the time it's around age 80 or age 85. Once you hit that age, the insurance company is going to pay you a lifetime income stream. Now, Congress used to allow a maximum of $145,000 or 25% of your retirement balance, whichever was lower, to be able to be deferred into a QLAC. Now they're increasing that to $200,000. Now, if you were to defer $200,000 into a QLAC, that could reduce your required minimum distribution because that $200,000 is not calculated in the formula for your RMD. So there could be some use cases where if you're worried about living a long time into your 90s or hundreds, you're worried about outliving your retirement assets, you want to reduce your RMD, the QLAC could be an interesting strategy to take a look at. The next one, another one I'm a big fan of, is catch-up contributions. Now, this is not going to go into effect until 2025 because Congress needed to balance the budget, and that could not happen until 2025 based on the additional spending. But for any individual over age 60 and under age 64, essentially, so age 60 to 63, you can put another $10,000 or 150% of your regular contributions into your 401k or retirement plan. And so that's the greater of the two. Let's play this out. Let's say we have a 62-year-old. They can put in this year $22,500. Because they're over age 50, they can do another $7,500 as a traditional catch-up contribution. Well, once year 2025 rolls around, they can actually put in even more because they're over age 60. 150% of their regular contribution of $7,500 catch-up is an additional $3,750. That means that this individual over age 62 can now put $33,750 in once this takes effect in 2025. So it's a way to juice up that catch-up contribution. Now, it's also been said that for certain high income earners, that additional catch-up contribution has to go into the Roth account. You can't defer tax because, again, Congress wants that tax money today. The next is 529 rollover, something I am a huge fan of. I think this is long overdue. For a beneficiary who has a 529 balance that maybe they've now graduated college, there's money still left in there, now they can roll that money over into a Roth IRA. This goes into effect in 2024, so we cannot do it yet in 2023. The beneficiary of the 529 has to have been a listed beneficiary for at least 15 years. So I can't have one beneficiary of my 529 do a rollover for them and then immediately list a new beneficiary and do another rollover for that new beneficiary. They have to have been the beneficiary for 15 years. And you must follow Roth IRA contribution limits, which is today $6,500. So let's say I had $20,000 left over in my daughter's 529. She graduated college. That 20 grand is just sitting there. If she cashed it in, any gains would be taxable, plus there'd be an applicable penalty for that. But what we could do, assuming that she's been the beneficiary for 15 years, is we can start doing a rollover of $6,500 per year from the 529 to the Roth for her. That gives her a great jumpstart on her own retirement savings. So this is going to create some important beneficiary planning around 529s that we need to think about if you're using those vehicles for college savings. The next for any of our self-employed clients is we've always been able to defer taxes and create really easy to administer for retirement plan options traditionally for a lot of sole proprietors. This is the SEP or the simple IRAs. Now we have a Roth option if you want to build tax-free money. Instead of doing a traditional SEP or a traditional simple IRA, we now have the Roth. And last but not least, for any of our clients that are over age 70 and a half and are charitably inclined, we can do what's called an IRA charitable rollover. Again, this is going to be different than a qualified charitable distribution, which we do for many of our clients over age 70 and a half, where you do a direct contribution right from your IRA to the charity and it's tax-free. In this case, the distribution goes from your IRA to a charitable gift annuity or a charitable remainder trust. You can be the income beneficiary on that. Let's say you're a 5% income beneficiary on a charitable remainder trust. The $50,000 leaves your IRA, goes to the charitable remainder trust tax-free. That gives you a $2,500 a year paycheck for a certain period of time or for as long as you're alive, in an example of a 5% charitable remainder trust. And then when that trust expires, it could be 10 years, 20 years, or upon your passing, any money left in that trust goes to charity tax-free. So again, a way to potentially suppress your RMDs while you're alive, have an income stream from the charitable remainder trust, and then provide for the charity upon your passing. So again, those are the big new tax law changes coming out of Secure Act 2.0. If you have any questions at all, please feel free, reach out to myself or David Roth. We can talk about how these changes impact your financial circumstances. Thanks a lot, everybody. Have a happy new year and a prosperous 2023.